90% of traders lose 90% of their capital in their first 90 days. That's a statistical reality, not an opinion. The reason is not a lack of effort, nor is it manipulation by invisible market makers. The reason they lose is that their chart is a chaotic mess. Retail traders clutter their screens with lagging indicators, hoping a magic algorithm will tell them exactly when to buy and when to sell. Professional investors do the exact opposite. We build objective systems that filter out the noise, manage risk, and expose the actual footprints left by institutional capital. If you are trading without a structured, data-driven framework, you are simply donating your hard-earned money to the professionals who do. Today, I'm opening the hood on my personal TradingView setup. This is the exact configuration I have refined over 8 years of daily market execution. I'll walk you through every single indicator, every drawing tool, and the exact settings I use to preserve capital and capture yield, regardless of market conditions. This system is the foundation of every technical decision I make. We're going to build this together, step by step, completely from scratch. You can follow along even if you are on the free plan. We are stripping away the hype and focusing purely on the data. Let us get to work. To build this setup, I'm going to use the Bitcoin chart on the daily time frame as our primary example. However, understand that the mechanics of this system apply universally. You can use this exact same framework on the 1-hour time frame, the 4-hour time frame, or the weekly chart. Market structure is fractal, meaning the patterns and rules remain consistent across all time horizons. The very first thing you must do before adding a single indicator is fix your price scale. By default, trading platforms use a linear scale, which represents price movement in absolute dollar terms. In crypto, where assets experience massive percentage growth, a linear chart will completely distort your view of historical price action. You must change your chart to a logarithmic scale. To do this, simply hover your mouse over the price numbers on the right side of your screen. You will see a small button labeled L. Click it. A logarithmic scale represents price movement in percentage terms, meaning a 10% move from $1,000 looks exactly the same as a 10% move from $60,000. This is the only way to accurately map long-term market structure. Now that our canvas is correctly calibrated, we'll go up to the Indicators tab at the top of the chart. The first tool we are adding is our momentum gauge. Search for the Heikin Ashi RSI Oscillator, created by the author Jay Rogers. Select it and leave it on the standard settings. Most traders use the traditional relative strength index, but the traditional version is incredibly choppy. It gives constant false signals, tricking you into entering or exiting trades prematurely. The Heikin Ashi version smooths out the momentum data by averaging the price action. It gives us a much clearer, more reliable picture of whether the bulls or the bears actually have control of the underlying trend. We are looking for momentum shifts that carry weight, not intraday noise. This oscillator is my primary filter for identifying true divergence and confirming the strength behind a move. The second addition to our chart is moving averages. Instead of cluttering the screen by adding multiple individual indicators, I'm using an indicator that aggregates multiple moving averages into a single script. Search for the 1 in your screen, created by the author Jara Waxman. This script plots the exponential moving averages for the periods of 10, 21, 55, and 100, alongside the simple moving average for the period of 200. Keep these on the standard settings to start. You can always go into the indicator settings later to change the colors or toggle specific lines on and off if you prefer a cleaner look. For example, some traders prefer switching the 55-period moving average to a 50 period. The choice is yours. The reason we use this specific cluster is to build a dynamic map of support and resistance. The 10 and 21 period exponential moving averages track short-term momentum. When price is holding above them, the immediate trend is strong. The 55 and 100 period averages represent intermediate macroeconomic shifts in value. The 200 period simple moving average is the granddaddy of them all. It's the ultimate baseline for secular bull and bear markets. By watching how price interacts with this specific ribbon of averages, we can immediately gauge the health of the market without second-guessing our bias. The third indicator we are going to deploy is the SuperTrend. Search for it in the Indicators tab and add it to your chart. The SuperTrend is a trend-following overlay based on average true range, which dynamically prints bullish and bearish zones directly on your price action. However, if you apply it to standard candlesticks, you'll occasionally get chopped out during periods of high volatility. To fix this, I utilize a specific trick. When I activate the SuperTrend, I immediately go to the top of my chart and change the actual price candles from standard candles to Heikin Ashi candles. Heikin Ashi candles calculate price differently, using averages from the previous session to paint the current candle. This aggressively smooths out the visual representation of the trend. When you combine Heikin Ashi candles with the SuperTrend indicator, you eliminate a massive percentage of false signals. You stop getting shaken out of winning positions by rogue wicks. You stay in the trade until the actual trend reverses. Seeing these concepts on a static chart is one thing, but applying them when the market is printing real-time volatility is where most people struggle. If you are serious about treating your capital like a professional operation, this is a perfect time to mention my private community, the Pro Capital Vault. You can access it right now through the YouTube members program on this channel. This is the exact war room where I share my daily execution. You don't just get theories, you get my exact real-time portfolio tracking, the specific buy and sell zones I'm looking at, and our weekly live strategy calls where we prepare for the week ahead. It's direct access to me and a community of data-driven investors. If you want to stop guessing and start executing with structure, click the join button below this video or use the link in the pinned comment. Once you join, just sync your YouTube account to Discord and it will automatically unlock all the private channels. Returning to our chart, the fourth indicator we need is arguably the most powerful volume tool available. Go to the Indicators tab and search for Volume Profile Fixed Range, specifically the one coded by the author Lonesome the Blue. Most retail traders only look at volume over time, which are the vertical bars at the bottom of the screen. Institutional traders look at volume at price. The volume profile plots horizontal bars on your chart, showing you exactly how much capital was traded at specific price levels. This tells us where the real value areas are located. It highlights the point of control, which is the exact price level with the highest traded volume. These high-volume nodes act like massive gravitational magnets for price. If price moves away from a high-volume node, it will often get pulled back to it. Conversely, low-volume nodes act as vacuums. Price slices through them rapidly because there is no historical friction to slow it down. Understanding volume at price is how you find entries with massive asymmetric risk-to-reward ratios. Now that our automated indicators are set, we move to the fifth step, which involves our manual drawing tools. On the left side panel of TradingView, select the Ray tool. I use the Ray tool primarily to map out trend lines and diagonal market structures. A ray anchors at a specific starting point and extends infinitely into the future. When I'm mapping an uptrend, I anchor the ray to the absolute lowest wick of a major correction and connect it to the next significant higher low. I don't cut through the bodies of the candles. I want to see the exact perimeter of the market structure. When price approaches this ray in the future, I know we are testing the boundary of the trend. If the ray holds, the trend is intact. If the market closes a daily candle decisively below that ray, the probability shifts, and I know it is time to reassess my exposure. The sixth tool is the horizontal line. This is your bread and butter for identifying macro support and resistance. Markets have memory. A price level that acted as a major ceiling in the previous year will very often act as a major floor in the current year. I use horizontal lines to map out these critical battlegrounds. But more importantly, I use them to calculate my invalidation points. When I enter a trade, I don't place my stop loss based on a random percentage. I place my stop loss mathematically below the horizontal support line, accounting for previous wicks so that I avoid getting swept in a liquidity hunt. If my horizontal line breaks, my thesis is invalidated, and I take a calculated, emotionally detached loss. The seventh tool on our list is the parallel channel. This is an incredibly effective drawing tool for mapping out structured upwards or downtrend momentum. When an asset is moving in a consistent trend, it rarely moves in a straight line. It oscillates back and forth between a diagonal support and a diagonal resistance. The parallel channel tool allows you to perfectly encapsulate this price action. I use it to spot potential breakout zones. If price has been bouncing inside a downward parallel channel for 3 months and suddenly prints a strong daily close above the upper boundary, that is a massive structural shift. It tells me the sellers are exhausted and the buyers have seized control. Alternatively, it helps me find logical profit-taking areas when price reaches the top of an ascending channel. The eighth tool, and this is absolutely critical, is the Fibonacci retracement. If you are not using Fibonacci sequences to measure the market, you are flying blind. I use this tool for two specific purposes. First, to identify high-probability zones for pullbacks and corrections. To do this, I anchor the tool from a major market low to a major market high. This projects the golden retracement levels below the current price, showing me exactly where I should be looking to deploy capital. Second, I use it to project profit targets during aggressive rallies. By anchoring the tool from a macro high down to a macro low, the Fibonacci extensions show me the mathematical targets above current price where price discovery is likely to pause. Here's the most important technical detail regarding the Fibonacci tool on TradingView. Because we set our main chart to a logarithmic scale in step 1, you must make sure your Fibonacci tool is calibrated to match it. Draw a Fibonacci retracement on your screen, then double-click directly on the lines to open the settings menu. Scroll down and make absolutely sure the box labeled Fib levels based on log scale is toggled on. If you forget this step, your levels will be completely wrong and your buy zones will be mathematically incorrect. You can also use this same settings menu to check or uncheck specific Fibonacci levels. I highly suggest you watch the specific video I recently made diving deeply into Fibonacci mechanics. I consider the Fibonacci retracement, alongside the Heikin Ashi Relative Strength Index, to be the absolute core of my technical analysis. The ninth component of a professional setup is not a drawing tool, but a risk management habit. You must utilize the alerts feature. Staring at a chart all day is emotionally draining and leads to forced, low-quality trades. Professional trading is about letting the market come to you. Once I have mapped out my horizontal lines, my rays, and my Fibonacci zones, I right-click on those exact price levels and add an alert. I set TradingView to notify my phone and my email when price reaches my point of interest. Until that alert triggers, I do nothing. I protect my mental capital just as fiercely as my financial capital. Let the alerts do the waiting for you, so when you finally take action, you are executing from a place of calm objectivity. Finally, the 10th step is personalizing your workspace. Every single indicator and tool I just discussed can be customized. Double-click any moving average, any horizontal line, or any volume profile to change the colors, increase the line thickness, or enlarge the text size. You are going to be looking at this screen every single day. Make it visually clear. Remove colors that strain your eyes. Use a dark theme to reduce fatigue. Create a visual hierarchy where the most important lines are thick and bright, while the less important data is faded into the background. A clean chart leads to a clean mind, and a clean mind makes profitable decisions. For those of you setting this up for the first time, or looking to upgrade your charting capabilities, I have placed my personal TradingView referral link in the pinned comment below. I'm not pointing this out just to push a tool. I have genuinely used TradingView every single day for over 8 years. It's the exact software I use to navigate all markets and build my portfolio. I consider sharing this setup a way of expressing gratitude to this audience, providing free institutional alpha that you can apply immediately. If you choose to use the link, I appreciate the support, but either way, the priority is that you actually apply these tools to your own trading routine. Let us quickly recap the thesis. We started by fixing the structural distortion by enabling the logarithmic scale on the daily time frame. We smoothed our momentum readings using the Heikin Ashi Relative Strength Index. And we built a dynamic macro map using a specific cluster of exponential and simple moving averages. We then filtered out price noise by combining Heikin Ashi candles with the SuperTrend indicator. Finally, we located institutional value areas using the fixed range volume profile, and we framed our exact execution zones using the ray, horizontal lines, parallel channels, and logarithmically adjusted Fibonacci retracements. The market is entirely composed of data, probability, and human psychology. Your only job is to manage risk and execute your edge when the data aligns. If you do not control your setup, your emotions will control your capital. Take the time today to build this exact workspace. If you found value in this deep dive, take 1 second to hit the like button and subscribe to the channel. It directly supports the data-driven research we do here. If you want to master the exact mathematical sequences I use to buy the bottom of corrections, I highly recommend you watch my full deep dive video on the Fibonacci tool right now, where I explain the golden pocket strategy in complete detail. Remember, everything discussed today is for educational purposes only and is not financial advice. Protect your capital, trust the data, and I'll see you soon in the next video.